Hey guys, continuing this series on tax planning. As always, this is not personal, financial, tax, or investment advice. It's just for education. So I'm really gonna break down in this video, I'm gonna start off a series of videos talking about the what of tax planning, meaning what does it impact? What areas does it impact? And really, I'm just gonna break down your money into really 4 things. There's only 4 things you can do with money beyond earning. Everybody's gotta earn money to live. But once you earn it, you can either save it, you can give it, you can grow it, or you can owe it. So I'm gonna start this video and just talk about save. So for most people, the primary place that they save money is in some form of employer-sponsored retirement plan. And realize the biggest tax planning decision you have inside that employer plan is going to be tax deferral or not. So breaking that down is back to our investment types. So basically, when you put the money into your employer plan, you can either put it in on a pre-tax basis, which means that it lowers your adjusted gross income in the year that you defer it into that plan. But years later, when the growth is tax deferred and it comes out, you have to pay income taxes on that money. That's what I mean by tax deferred. So you have to make that decision of, should I defer that income? Now, most people are gonna make the decision to do that when they're entering higher tax brackets, meaning they are in their highest peak earning years, and they may think that their tax bracket, when they're going to withdraw the money, for most people that's going to be retirement, is actually going to be lower. Therefore, you deferred at a higher tax bracket and you took it out at a lower tax bracket. That would be a good decision. The reverse could be true. You could just be starting out and you really want to accumulate some tax-free dollars. In that case, you'd want to save that money on a Roth basis. So that's not going to lower your adjusted gross income in the year that you put the money in, but once you've already paid the taxes on the money, when you distribute it, you're never going to have to pay taxes on it again. Now, that would be the primary way that most people would save first. Now, there's a second type of account that would be a investment account or a brokerage account. Now, how you invest inside that account can also have taxable implications. Everything you do in that account, whether it's own a bond or buy a stock, is going to have taxable implications. And you need to think not only how am I investing in it, but how is it affecting my taxes every year? And what is my situation going to be when I withdraw the money? So for example, something like a strategy of tax loss harvesting, that could be great, but the downside of that is the basis in that account could be lower. So if you know you're going to be in the 0% capital gains bracket when you remove the money, it doesn't matter if you have a low basis. If you know that you want to give that money to your children as a legacy, it doesn't matter. These are taxable planning decisions. You want to be talking to these things over with your financial planner or your tax team. Hope that's helpful. I'll see you next time.